We need to talk about what's really happening in the stock market right now because the S&P 500 and the Dow are consistently making all-time highs, while meanwhile, a lot of the retail investors' portfolios in growth and small cap stocks, well, we've been suffering. So if you're confused or frustrated over why the market seems to be doing so well, but your portfolio maybe isn't, this video is for you. I have a few different charts to show you in this video that might explain what's been happening and also maybe even get you excited for what may unfold in the market over the next 6 to 12 months. Let's do it. What's going on, everybody? My name is Matthew, and today we're going to be doing a bit of market analysis, looking back at the past 6 or 8 months and looking forward to the next few months as well. So if we're being honest, many of our portfolios probably looked a bit like this. They rocketed upward in 2020 with no end in sight, but then in February and March of 2021, they either maybe crashed or flattened out or continued to downtrend. Meanwhile, the S&P 500 and Dow are soaring to new highs on a weekly basis. So what is going on? Here is my take. So I'm actually going to borrow a bit from our Discord over at Investor Community. You can check that out down below, probably in the pinned comment. But this is posted by Kevin D, one of our mentors. He's our technical analysis mentor. And yes, this is actually his setup. He's been trading since the 90s and makes his full-time living from trading now. But he posted a great article about second-year behavior for a bull market. So big shout out to Kevin. And this is the article here, Classic Year 2 behavior. What is going on? Okay, classic year 2 market behavior for a bull market. And most of this article is just charts for the S&P 500 after a recession, depression, or stock market crash. So here is the first one, right? I'll zoom in a little bit for you guys so you can see this. But in the low of 2009, after the 2008 great financial crisis, we can see that it hit a low and then thrusted upwards and then saw a sideways chop. So this thrust lasted about a year and then this chop continued for about a year. Next, we can see the low of 2003 after the dot-com bubble had burst. There's a thrust upwards for about a year. This is at the beginning of 2003, and this is about the beginning of 2004. So the thrust lasts about a year, and then a sideways chop. Then we go even further back into time to 1982. We find a low there, then boom, there's a thrust. This one doesn't quite last a full year, but it's kind of close. And then there's a long sideways chop. And then the low of 1974, we see another thrust upwards, and then this was a sideways chop, a bit more to the downside here, but ultimately it is kind of a sideways chop. So if we look back through history after a crash, we see this pattern. Now, this is where things get interesting. You see, another thing that our technical analysis mentor, Kevin, always reminds us is that the market never repeats, but sometimes it rhymes. So let's see how good of a lyricist today's market is. Get it? Because we want to see if it rhymes, and that's like part of making lyrics. Okay. Anyways, when we look at the SPY, and when I say SPY, I'm talking about SPY, which is an ETF that tracks the S&P 500. So in this video, for purposes of this video, S&P 500 and SPY are interchangeable. So when we look at the SPY, it does not follow this historical trend of thrust and flat. In fact, it's just thrusting and it hasn't stopped thrusting. So we need some more context. So over here on the right is the Russell 2000, or this is actually IWM, and IWM tracks the Russell 2000. The Russell 2000, if you don't already know, is another index that tracks 2,000 stocks, and most of them, or many of them, are growth stocks and small cap companies, and that makes up a good portion of retail investors' portfolios at the moment. So that's probably why your portfolio might look very similar to this exact chart. Now, we can see here that it actually follows the pattern of the previous charts showed in this video of a thrust and then movement sideways right here. Now, will it crash after breaking through this support, or will it bounce up and continue to trade sideways, or will it bounce up and continue to uptrend? We don't really know. But what we can tell is that the Russell 2000 small caps growth stocks, they followed this trend, but the S&P 500 did not. So this is why it feels like the market's doing super well, but your portfolio is staying flat. Most likely because your portfolio composition is closer to stocks within the Russell 2000 than it is to stocks within the S&P 500. Now, that poses the question, why is the S&P 500 continuing to thrust while small caps and growth stocks are not? And that's the next part of this video. All right, so now we're looking at just the Russell 2000 through IWM. We're looking at its chart here, and this right here is the March 2020, or the the crash of 2020, and this is the March 2020 bottom, and this is where we are today. Okay, so this is about maybe a year and a half worth of time shown on this chart. So let's talk about the story of this chart, and I think that's a great part of analyzing stocks is finding the story behind it. So obviously the Rona comes in, causes everything to drop, but then the Fed steps in at the bottom and says we're going to provide liquidity and we're also going to lower rates extremely low. And that means a lot of these small cap and growth companies are now able, with these lower rates, to borrow money at a much cheaper level, at a much cheaper rate, and therefore fuel their growth. Because a lot of these smaller companies, these growth companies, they burn a lot of cash to continue to grow revenues, and they're focusing on earning profit and earning money and creating earnings in the future, right? So that's why a lot of these stocks are doing really well in a low interest rate environment. Additionally, you have lockdown, and that means a lot of people are staying home, and a lot of stay-at-home stocks are doing really well, and a lot of those were also small caps, right? Now, throughout 2020, the market just goes absolutely bonkers. There's so much money in the market because you can't really get a yield anywhere else, right? Savings account are paying pretty much nothing. Bonds get pretty much nothing. And a great place to go was the stock market to get returns. And this is also really important context to keep in mind here, okay? So I'm going to draw a line. It's going to show us what the return is of IWM, or the Russell 2000, since the crash, or since the bottom of the market in March 2020. So I'm going to go to the peak in February, right before things started to go south for growth stocks, and that's 140% return from the bottom. Now, if we look at the SPY from the bottom and going to February, right, we'll zoom in here. This is the bottom in March 2020, and we'll drag it to February. So right here, this is an 80% return. So the Russell 2000 outpaced the S&P 500 significantly in terms of returns from the bottom of the stock market crash in March 2020 up until February. So when this chop began, there was a lot of news about an improved economic outlook, and that threatened early tapering of Fed rates, which means the market started to fear that the Fed would actually raise rates sooner than they'd promise. And this hurts growth stocks who rely on that cheap capital that we talked about earlier. They rely on lower rates for borrowing, and it also hurts the way that their valuations are modeled because, again, they're pushing earnings far into the future. So in short, higher rates is not really great for growth stocks, and that's when a lot of the higher rate talk kind of started. Here's an article explaining that, and it's actually a prediction from February 2021 saying, as economic expansion continues and inflationary pressures build in markets, the valuation of growth stocks appears more and more risky as the tailwind of lower rates potentially shifts to a headwind of moderately higher rates. And at this time, stay-at-home stocks were also hammered as cases of the Rona dramatically fell. This is a good thing, but it was bad news for stay-at-home stocks, meaning that not only could the hyper-growth prove unsustainable, but these companies had to face very strong and difficult year-over-year comparisons. And what that last part pretty much means with the year-over-year comparisons or year-over-year comps is that in Q2 of 2021, kind of during the height of stay-at-home orders, a lot of tech companies and growth companies actually thrived in that environment and produced some of the best quarters in company history. Now, a year later, where things are a bit more normal, those same companies have to compare this year's Q2 numbers with the numbers of Q2 2020, which again, were some of their best numbers ever. And that's a very hard act to follow up, which can set us up for disappointment or set Wall Street up for disappointment, which could lead to drops after earnings reports or stagnant stock prices. And finally, a visualization I always like to make is let's draw a slope here, and let's call this slope the fundamentals of companies, right? And I've made this comparison or visualization a couple of times, but I think it's super helpful to revisit, okay? So I'm gonna make this a little bit bigger here. So let's say this giant golden line is like the earnings and fundamentals of a company. It is improving slowly and steadily, and this is stock price, right? It's trying to you want stock price and fundamentals and earnings to kind of stay closer together, because if it does this and it shoots way too far ahead, then your stock is now at a really high valuation, and it's gone too far ahead of the fundamentals of the business. And now it either needs to stay stagnant and wait for those fundamentals to eventually catch up, like it looks like it's doing over here, or the stock price is going to come crashing down and maybe even go past fundamentals. And that's, I mean, as long-term investors or value investors, that's where you really want to buy. But hopefully it comes back to the mean or where earnings and fundamentals make it make sense. Now, this is a completely arbitrary drawn line. Like it doesn't actually have, that was just a random line to illustrate the point, but hopefully you get what I'm saying. And that's why it makes sense why things are chopping, because there is no doubt about it that the stock prices of growth and smaller cap stocks got ahead of themselves compared to their actual earnings. And some of them didn't even have, or most of them don't even have earnings. So got ahead of their revenue even, right? And the way you can tell is because back in February 2021, I remember when everything was going crazy and going upwards super fast, the first thing I looked at for a stock was actually their forward sales multiples, which means that I was looking at their sales multiples for at least 1 or 2 years out, even though I'm looking to invest in it today. And if I immediately have to look 1 or 2 years out, that means it's probably ahead of itself, right? Quite literally ahead of itself. So I thought that was an interesting kind of telltale sign, right? If we ever see this in the future, where if I'm automatically looking at their forward multiples first instead of their last 12 months, that's probably a sign that things are getting a little too hot. So now that we've seen this chop, we're about 3 to 4 months away from completing a year of going sideways. Does that necessarily mean that we're going to see that second leg of the bull run? Maybe, maybe not. Maybe 1 quarter is enough for those fundamentals to catch up to the stock price of some of those stocks and find them at a good valuation again and then continue to be bought up. But really quickly, I also want to answer the other question of why does the SPY keep thrusting upwards while the Russell trades sideways? And here is my theory. So the SPY is very top heavy, with the top 10 holdings making up 27.3% of total assets, and 21.82% of the ETF is actually made up of FANG stocks. So we already talked about why raising rates earlier than expected and a higher economic outlook could actually hurt the price of small caps and growth stocks. However, with blue chips and mega caps, I don't think that's necessarily the case. You see, a lot of these stocks, especially the FANG stocks, which again make up over 20% of the S&P 500, have mountains of cash and bulletproof balance sheets, which means they don't rely as heavily on financing. Therefore, if there's an increase in rates, I don't think it affects them as much. Apple, for example, has $121 billion in current assets, with $38 billion and $31 billion of that in cash and marketable securities. And furthermore, even if they needed money, FANG stocks like Apple get some of the best rates from banks and on their bonds. You also had stocks like Google, which were deemed undervalued at the time, even now by some, making up nearly 4% of SPY. So again, FANG stocks, and not even including Netflix, make up a huge portion of the S&P 500, and if they do well, generally speaking, the S&P 500 will most likely do well. And the SPY continues to thrust while the Russell continues to chop sideways because, again, my main reasoning for this would most likely be a fear of an early rise in interest rates. And that affects small caps and growth stocks much more than it affects stocks like FANG stocks, like Apple, Amazon, Google, and Facebook. I guess one really weird way to explain it that just kind of popped into my head is if you had 2 different metal balls and they were moving like this together, and you have a magnet over here that only attracts one of the balls. So if they're going up like this, then the magnet turns on. One of the balls, the Russell 2000, is going to go sideways while the other ball is unaffected or not as heavily affected and continues to go upwards like this. So that magnet would be the catalyst, which would be a potential rise in interest rates earlier than expected. So hopefully that makes sense. Now, what can we do with this information over the next several months? Now, first of all, I would definitely watch the support level on the IWM or Russell 2000 and see if that holds. If it doesn't, things honestly might get a little bit ugly for small caps and growth stocks. I would also look at my portfolio and my risk tolerance and allocation to different positions, right? Because say you have a lot of money in a certain stock that's trading at a very high multiple, it's a small cap, that might be a little bit risky because if the Russell or the market in general enters some sort of correction, that stock in particular, or those types of stocks will likely correct much harder than the overall market because some of these stocks, although they've come down 40-50% from their recent highs, are still trading at very expensive multiples. So just be cognizant of that. For example, with me, I bought PLBY, Playboy Group, at a very expensive multiple, which is why I only allocated 2% of my portfolio to that position. So I am down big on that, and I'm going to have a video for you guys soon. But it doesn't actually affect my overall portfolio too terribly because I kept it at a smaller position. So that's risk management. And lastly, with some cases on the rise due to the arrival of new variants, if that extends stay-at-home orders, that could put a damper on economic outlooks. And if that happens, then the Fed could be forced to continue with expansionary policies, which means they will likely keep rates lower for an extended period of time. And with a dampened economic outlook, investors have more of a reason to actually trust the Fed that they will keep those rates lower. And that in turn could give them confidence to come back to small cap and growth stocks for the time being. So whether or not that lines up with that chop period, and then we see another leg up, I don't know. It very well could. It's really hard to predict the market in the short term, but if this video was helpful in any way or maybe gave you a new perspective, please make sure to hit that like button and subscribe. And also, if you want daily newsletters to stay up to date with the market, if you want to track your stocks, your crypto, and listening to earnings calls, and more features coming soon, make sure to download the Hungry Bull in the description below. It's an app for iOS and Android. Super cool project that I'm a part of with Jeremy from Financial Education and Graham Stephan. And lastly, we do have our Palantir case study going on with investor community, 4 live sessions. We've already done 1, but they're all recorded for members, and it's being led by Nick, who is a full-time performance analyst at a wealth management firm, and also our proud fundamental analysis mentor at investor community. So that'll be down in the pinned comment below. If you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.